Hello, investors. Thank you so much for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today, I'm going to do my podcast that is, I kind of released this at 9 a.m. Eastern Time on Fridays. So I kind of was doing this live, but I opted to kind of go and do it offline and then kind of upload it. The reason being that kind of gives me a bit more time to prepare and think through things that I really want to kind of highlight that I think are worthwhile noting. So I kind of call this like the name of the podcast is going to be Stock Stop Clock. I'm going to go through that because some people wrote to me kind of asking me to explain this a little bit more again. And so I'm going to go through that. I'm going to talk about investing through this period. And then I'm going to kind of highlight some data to the reasons for remaining invested in the market. And finally, as always, I'm going to wrap up with three book recommendations. So I kind of call this a 3 and 1 because it's like three topics and that book recommendation at the end. So I'm going to go through this, and I think that it's kind of worth highlighting. So what the stop clock is. So I just wrote an article about Sophie Technologies, but I mean, this is, you can look. I don't know if you're investing a lot in high growth names like I am, but if you're investing in high growth names, this is probably applicable to some of the stocks in your portfolio. So the what the stop clock is you're investing in a stock, right? So you know the stocks can go up as well as down. So when everyone thinks about, for example, volatility has very negative connotations. Everyone understands volatility to mean a drawdown, okay? When people think about stocks going up as well as down, everyone thinks about it's just simply going up. These two are the same thing, really. And it's not that stocks only go up, and it's not that stocks only go down, but it's really, really painful when a stock goes down. And that has dramatic implications on your psychology. So when you're investing, you are trying to buy something for less than it's worth. You can call it value investing, growth investing. It doesn't really matter. None of this matters. What matters is you're deploying capital today for what you believe is going to be more valuable in the future. It doesn't matter too much whether you're going to hold for a year or two or longer. That doesn't really matter. Everything that you're trying to do ultimately is buy low and sell high. So you've made your research, okay? Let's just jump to the queue, and you kind of done a lot of research on this, and you kind of understood the business well, and you kind of invest in the business, okay? And you like it, everything is going well, and the stock is falling since December. So since December, it's been a difficult time, and stock is falling, and you're down, let's say 20-30% in 30 days, which is brutal. And what happens there is that you're kind of committed to being invested in this for a while, and things turn sour. So by you selling out of that position to start your portfolio 2022 afresh, what you've actually done is you've wound the clock back. So you stopped the clock. So the new stock that you're moving to is what I've referred to as the stock stop clock, because you're having to start that process again. Every time that you're going to sell out of a position is your admission of failure. You kind of said, okay, for X, Y, Z reasons, this didn't work out. And let me be perfectly clear. There's always a reason to sell out of a stock. Okay. The Fed said this, or the management said that, management is selling, executive compensation is too high, path to profitability is low, interest rates are going this. There's always a reason to exit out of position. And nobody thinks about those arguments while the share price is going up. Back in 2020, when things were kind of, everything was going up and up and up and up, none of this mattered. People didn't care about any of that stuff. Okay. But now that is the time to get kind of investing, and now that is the time to kind of be interested in the stock, everyone is kind of like, okay, I'm going to dump this, and start the portfolio fresh. So whenever you make an investment, you have to think about it. You're taking a portion of the business. And if you're going to exit out that position, you're going to be saying to yourself, okay, you know what? I decided that this business isn't really worthwhile investing in, and I'm just going to kind of everything that you kind of thought about previously in the back of your mind, all of a sudden comes front of your mind. Your cortisol is going through the roof, and you're kind of like, okay, I gotta act. Everyone is like, and particularly you're looking at other sectors of the market and everyone's kind of doing really, really well, and you give up your strategy. And let me make this clear. So no strategy is going to work out really well over all the periods, okay? But don't give up on your strategy just because it's not working in the past 30 days. Everything that you've done is right, okay? And it there are trying periods in the market, and it's trying when everyone else talks about doing really great returns. Everyone's like, "Oh my God, I just killed it! I killed it!" So you're like, "That's fine. That's their journey." I've always said to anyone that listens to me, your goal is to move the portfolio up in approximately 15% compounded. But you have to recognize that it doesn't matter whether it comes from one stock or comes from many little stocks, it doesn't really matter. That's down to your own personal investment strategy. But you must recognize that there are going to be good periods and bad periods. And if you take a step back and you look at how your portfolio has done over the last 3 years, you say, okay, the things have done quite well for me. And you think to yourself, okay, kind of got pulled forward and now I'm kind of giving back some of those gains, but that's perfectly fine. So I hope that that kind of explains my rationale behind a stock stop clock. So it's really about trying to kind of say, okay, I'm going to remain committed because the risk reward of the positions right now are much more favorable than they were just, let's say, 3, 4 months ago. Because a lot of these stocks are now down, let's say 30, 40, 50% from their highs. I mean, many stocks in the spaces that I follow, which is kind of like high tech growth stocks, and they're really like at, let's say, at a 52-week low or even all-time low. Many stocks are like that. So the market has just been obliterated in this space, and you have to recognize that from this point forward, there are so many really compelling businesses, and you don't have to agree with me on what the businesses are. That's absolutely fine. I was saying to somebody today, I wake up Friday morning and I'm like, okay, I'm going to have a really healthy dinner on Friday night. And then Friday night comes around and I disagree with myself and I'm like, okay, I forget all that. I'm just going to go and have some junk food because I deserve it. So if I can't even agree with myself over a period of 12, 16 hours, I mean, you don't have to agree with me because you don't even know me. So, like, you don't have to agree that, let's say, I believe that Upstart is a good business. You don't have to believe that I believe that Fubu is a good business. But you have stocks in your portfolio right now, and you kind of thinking, and you have doubts. And I'm just saying, okay, the risk reward from this price point is very, very favorable. That doesn't mean that the share prices will not continue to kind of go slightly lower. What it does mean is that from this price point, I don't know how it works out over the next 2 years, but from this price point right now, things are going to dramatically improve. And yeah, so this kind of leads me to the next point that I wanted to really cover here, which is investing for this period. I mean, so the back end of any kind of fiscal of any annual year, December really is now everyone just sells off. Like that happened in October, November 2018. That kind of that period then, and it's happened really dramatically right now. There are these periods, right? So where things just kind of really dramatically like sell off, but the underlying businesses are really continue to clog to go ahead because businesses, they don't know really that it's a 365 period and, you have to sell for tax reasons. So many businesses are doing really, really well. And this is a business that actually make the most amount of profitability, which is ironic, right? Because businesses are doing their best profits right now. And at the same time, their share prices are doing the worst. And it's kind of, that's why I said, whenever you make an investment, it's really, really important that you do a couple of things. The first and most important thing is that you do a tiny bit of work. Write down 3 bullet points why you want to invest in a business and write down the valuation. Okay. And then before you decide to sell, just look at that piece of paper. I said this as every podcast I say this, and I just keep drumming this in because it's so important. Because a lot of people kind of get shaky legs and stuff like that, and they're kind of very passionate to invest. Back in, let's say, February of 21, like people were just kind of like really, really passionate to invest, and now that is actually the point where you should be interested. This is the time that you should be kind of deploying capital. People are like, I'm going to wait for a better time. So people didn't want to wait for a better time back in February when share prices were offering very low potential return from that price point. But now the things are really, really in the dumps, and your risk reward profile is much, much higher. People are like, okay, I'm gonna just wait, see how it goes, what the Fed says, this and that. Like, and I find it baffling, because a lot of these businesses, they're on the cusp of profitability, or they're already kind of already profitable, and people are just wanting nothing to do with it. And I think that's really kind of, you know, interesting to see. For example, Upstart. In the case of Upstart, is a business I've been very vocal about that I do very much. I'm very bullish here, and I own a position. So for the sake of disclosure, and Upstart is already gap profitable, and they're already generating a ton of free cash flow. So like they don't need. You look at their balance sheet; is like a very clean balance sheet. Yeah, they do carry those 2026 convertibles at 0.25 on the interest rate, but for all intents and purposes, the business is already generating ample free cash flow. And it doesn't make a lot of sense to me why all of a sudden people wouldn't want unsecured loans. Yeah, there's a kind of question mark about whether Upstart is going to be successful going into refinancing the auto industry. And yeah, there's always worries, there's always something to be worried about. But the time to get word isn't now, right? So the time to get word would have been, I mistimed this, but the time would have been, let's say back in August. That would have been a time to kind of maybe be concerned if you want to be concerned. But if you're kind of investing enough time, you can translate this into other businesses as well that you probably own. And then the time to be interested and to kind of be investing is right now. Now, let me just make this one more thing clear. The way that I believe you should invest, or dollar cost average, or whatever, is to be led by time, not necessarily to be led by the share price. So the way to do it is that you stagger your entry into stocks approximately 4 to 6 weeks apart. So because a lot can happen in 4 or 6 weeks, and the game is not for you to kind of get in there and perfectly time the bottom and perfectly time the top, because that's not going to happen. That's just fiction. What you need to think about is being an investor yourself and thinking as a business owner. Try and buy businesses that you want to own. Okay, don't buy junk. Like because everyone else is buying junk. I mean, forget it. That's their problem. When things go off, that's their problem, and they won't have their conviction. But buy things that you believe in. That you say, okay, that's a really high quality business that's offering a product that's really rewarding. And one of the things that I just wanted to mention briefly, it's not particularly about investing in the spirit, but just more generally, follow the customer growth, because the customer really knows what they want. Okay, if you see a large increase in the customer adoption or user growth, that's something that's really interesting, and they know best, and that shows that the business then can have some more pricing power, which can just fall to the bottom line. Particularly in the businesses that I look at, which is kind of like software, the marginal cost. So there is a bit of a cost associated with, let's say, onboarding that customer in the first year. But once the customer is there and stuck around, the value of that customer dramatically increases, and you're not having to increase the proportional amount of cost to sell or service that new customer. So your labor costs or your technology or whatever, it's not going to proportionately increase with having more and more customers. So I believe that's something that's really insightful, and that gives me a lot of conviction, because when things go sour as they do right now, I think that just by trying to kind of see this through and just stay invested, and I think that this is something that's really worthwhile doing. Okay, the other thing that I wanted to highlight is this. Okay, so I kind of got this quote from Terry Smith's book, and I think it's really interesting, and I want to share with you. Okay, and everyone says, okay, I want to kind of invest, but I like to kind of keep some cash on the side. Okay, now I always talk about investing as a 20-year game. You have to do whatever it takes to be invested for 20 years. The example I always give is that, let's say you're an amazing investor and you compound for 20 years at 16%, okay, which is incidentally is approximately what Charlie Munger's limited partners did. So if you compound and you put 10K and you stay invested for 20 years at 16%, your return is going to be approximately 115K, okay? Now, let's say that you're not quite as good and you want to, you kind of have a 13% compounded return, and you put 10K and you just top up by 1K, $500, sorry, every month, okay? And your return in that instance goes from 10K to 514K. So it's really important to show that it's about not only staying in the game, but adding to your portfolio over time. Now, in Terry Smith's book, Investing in High Quality Companies, he talks about this, right? So if you were to be investing in 10 years from December 1994 to 2004, and your return would have been 12.7%. That implies that your 10K goes to 31K. So you just put in 10K goes over 10 years to 31K. Okay. Now let's say that you got a bit shaky and on 10 days you would have taken some your capital out of the market. So you would have missed out the 10 best days. And you could say you would have missed out probably on the 10 worst days also. But markets more often than not go higher. So for all intents and purposes, on average, you would have been missing out the 10 best days. And your return would have gone from 10K to 19K. So it's substantially less, right? And if you missed out 30 days in a decade, so in a whole decade, you just missed out on the 30 best days, your returns will actually be negative. Really puts in perspective how important it is to not try to time the market, but spend time in the market. And I think that's really something that's very important to think about, particularly right now. The other thing that I wanted to mention, and you know, try and buy businesses that you want to own, and try and buy businesses that you can see that their unit economics are improving every quarter. Okay, because it sometimes this is a two kind of edged sword. So on the one hand, you want to pay attention to the consolidated business. The reason why you want to do that, because sometimes when you're looking at just at the unit economics, those numbers are too brushed up. I'll give you an example. I was invested in skills. I'm not investing in skills anymore. But when they talk about their user economics, they brush up those numbers too much, and they don't actually include the cost to acquire the customer. So, sometimes you kind of things get polished too much, and it kind of takes you down the wrong hole. So you want to pay attention to the total company, and you want to pay attention to the unit economics of the individual user to try and get an understanding for that. So you do want to be invested and stay invested, and you have to set up your mind and your life to be able to do that. Okay, so you invest what you don't need for the next 3 years, and don't touch that capital. Just stay there and don't kind of invest what you're gonna need in the next 3 years. If you're gonna need capital in the next 2 years, keep some portion aside, and that's what you need to buy your house or what you need to pay for whatever your electricity, whatever. But just do whatever it takes to stay invested. I think that's really an important thing to think about, particularly right now. Finally, so here are my three kind of book recommendations. So this is a paper. So the Joe Greenblatt's 1981 paper. I think this is really nice to read. It was called How the Small Investor Can Beat the Market. And you'll see there Richard Benzina is there with Greenblatt. I think that's kind of, if you know Richard Benzina, it's kind of interesting to see those two in a paper together. And what it talks about is buying stocks or only screening and buying stocks on a PE of less than 5 or selling below a price to book value of 85%. Okay, so they call it liquidation value. I know you don't kind of find those types of stocks anymore, but what is particularly insightful about this paper is even though there are 2 years or so in the 13 years where there were no stocks available that met that criteria, if even with missing out 2 years and staying on the side, by buying something so cheaply, you'd have compounded your portfolio at 30%. Now, that's obviously contra to what I just said right now about staying invested at all costs. But it's kind of interesting to get a different perspective, and not being contradictory. I'm just kind of giving you a different perspective of the importance of being value conscious and thinking about buying something for less than it's worth. So I think that's a really great paper. I wanted to kind of share with you. The other thing that I wanted to kind of mention is another book is The Money Masters of Our Time, which is the 2003 edition, because this is a previous edition, and it talks about different investors, some better known, some less well known. One that I particularly enjoyed is reading about John Neff, because I didn't know too much about John Neff. John Neff's investment strategy is value oriented. It's very much quantitative, but it wasn't someone that actually was using quant data. So I think that's something that's quite interesting. And had to kind of jump around, which is really annoying. Yeah, so the final one I want to talk about is Tobias Carlyle's Deep Value. So obviously, this is, I name my marketplace Deep Value Returns. I think that that's something that really resonates with me. it's kind of a lot of it on the surface is like something that you kind of know about. You might not agree or disagree with, but what I think is kind of interesting is the footnotes to the book, because I think that the footnotes is something that really helped me kind of understand about investing, and the way that he did a lot of research in the history of different investors that you might not have known about puts a spotlight on Carl Icahn as well. So yeah, so kind of running this one podcast a bit shorter today than normal. But yeah, so I hope that you guys found this useful. If you did find it useful, please drop me a like, just so that it kind of motivates me to kind of keep going. And yeah, I hope you found this useful. I'll see you next time. Okay, thank you. Bye bye.